Excel tutorial, Magdi stock technical indicator. Stock technical indicators are calculated by applying certain formula to stock prices and volume data. They are used to alert on the need to study stock price action with greater detail, confirm other technical indicator signals, or predict future stock prices direction. This topic is part of Stock Technical Analysis with Excel course. Feel free to take a look at course curriculum by clicking link at description box below. This tutorial has an educational and informational purpose and doesn't constitute any type of trading or investment advice. Please read full tutorial disclaimer at the end of this video. Moving averages convergence divergence, commonly known as MACD, consists of centered oscillator that measures the stock price momentum and identifies trends. 12 days are commonly used for short-term smoothing, 26 days for long-term smoothing, and 9 days for signal. Notice that this number of days are commonly used, but they're not fixed and therefore can be modified according to your needs. For full reference, I recommend that you read Gerald Appel, Technical Analysis, Powerful Tools for Active Investors, published by Financial Times Press in 2005. Technical indicator is calculated through following steps. A. Short-term and long-term smoothing calculation. Short-term and long-term smoothing calculation is done through exponential moving averages. Therefore, here we have the first for the short-term smoothing calculation, in which current period 12 days exponential moving average of close prices is equal to 2 divided by 12 plus 1 multiplied by current period close prices minus previous period's exponential moving average, and that result we add previous period's exponential moving average. For the initial 12 days exponential moving average of close prices, it is equal to a 12 days simple moving average of close prices. The calculation of long-term smoothing is also done through an exponential moving average of close prices, but in this case for 26 periods. B. Moving average convergence divergence indicator calculation. Current period 12 and 26 days MACD of close prices is equal to current period 12 days exponential moving average of close prices, or short-term smoothing, minus current period's 26 days exponential moving average of close prices, or long-term smoothing calculated at previous step. C. Moving average convergence divergence indicator smoothing calculation. Current period 9-day MACD smoothing or signal calculation of close prices is equal to current period 9 days exponential moving average of the 12 and 26 days MACD of close prices calculated at previous step. D. Moving average convergence divergence indicator histogram calculation. Current period 12, 26, and 9 days MACD histogram of close prices is equal to current period 12 and 26 days MACD of close prices minus current period 9 days MACD smoothing or signal of close prices calculated at previous step. Great. So let's go into the Excel file so that we can study MACD stock technical indicator with greater detail. Excellent. So here we are within MACD stock technical indicator Excel file. We'll begin working within the orange colored MACD data worksheet. Within it, we have the following. At column B, we have dates, and then we have from column C to column H, first open, high, low, close prices, then volume, and then adjusted close prices, which were adjusted for dividends and splits. This corresponds to SPY data. SPY is the ETF investment vehicle which intends to replicate the Standard & Poor's 500 index. As we can see, data is with the daily frequency, and it's from the beginning of 2016. So we select B7, press Ctrl down arrow all the way to the end of 2016. Therefore, 1 year of data, 252 observations for each of this time series. So we press Ctrl up arrow, down arrow to go into the beginning of the time series. So once we have the data, we can continue with the MACD calculation at its corresponding worksheet, also colored in orange. Within it, first of all, we have from columns B to F, dates, and then open, high, low, and close prices. For this technical indicator, we'll only be using column F, which are the close prices. For this data, if we select any of the cells, for example here B7, we see that it's equal to MACD data worksheet, cell B7. For the calculation of the moving averages convergence divergence, which is a center type of oscillator, first of all, we need to do short-term and long-term smoothing with 12 and 26 days exponential moving averages. So the calculation of the first of these corresponding exponential moving averages for 12 days found at column G, we need to scroll down. And we find the calculation right over here. Notice that the first cell here, which is G18, has a different colored background to the rest of the column. In this case, it was colored in blue to highlight the different calculation to the rest of the column. So as we can see here, it's calculated with the built-in Excel function of average from F7 to F18. So we scroll to the beginning and select from F7 to F18. And we can see that that corresponds to 12 observations here in the count. Therefore, we're calculating the first of these exponential moving averages as a simple moving average with that built-in Excel function of average from the first observation into the time series all the way into current period. So again, we select it and we see average built-in Excel function from F7 to F18. From the following row onwards, we see the calculation as follows at G19. It is equal to 2 divided by 12 plus 1, and then we multiply that by F19, which is current period close price, minus G18, previous period's exponential moving average, and that result we add G18, previous period's exponential moving average. Then we calculate at column H the long-term smoothing. So we scroll down because we need at least 26 observations for the first calculation, which again has a different color background to distinguish its formula to the rest of the column. So again, we use the built-in Excel function of average from F7 to F32, and from H33 onwards, we see that it's equal to 2 divided by, and now instead of 12, it's 26 plus 1, the number of periods in the exponential moving average, multiplied by F33, which is current period close price, minus H32, previous period's exponential moving average, and to that result we add H32, which is previous period's exponential moving average, and so on for the rest of the column. Then with this too, we can calculate the MACD, which is found at column I. The first of this at I32, which is equal to G32, which is the corresponding short-term smoothing at that same date, minus H32, which is the long-term smoothing, also at that same date. And now we're going to do the smoothing of the MACD with the MACD signal. So we need 9 observations of the MACD to calculate the first value. Again, has a cell with a blue color background to differentiate its calculation with the rest of the column, and we see that it's equal to the average from I32 to I40, therefore 9 observations of MACD. From the following row onwards, which is J41, we see it equals to 2 divided by 9 plus 1. Now the exponential moving average is of 9 periods, multiplied by I41, which is current period MACD, minus J40, previous period signal or exponential moving average, plus that result plus J40, which is previous period's exponential moving average or previous period's MACD signal. And last, we have the calculation of the Magdi histogram. The first of this at K40, and it's equal to I40, which is that same period MACD, minus J40, that same period MACD signal. Excellent. So now that we've finished doing the calculation of the MACD, let's go ahead and visualize it within its corresponding chart at MACD chart worksheet, also colored in orange. So right here we have the corresponding chart. Moving averages, convergence, divergence, the last notation, which is the Magdi histogram, 12, 26, and 9 days at time t, and the corresponding technical indicator. On the vertical axis, we have the values for the corresponding Magdi, the signal, and the histogram. Notice it's a centered oscillator at 0. At the bottom, we have dates from the beginning of 2016 to the end of 2016. According to the legend, we have colored in blue, that's the Magdi, 12 and 26 days. Dash red line here is the MACD signal, that 9-day smoothing of the MACD. And last we have coloring green the corresponding columns at the back, which is the MACD histogram for 12, 26, and 9 days, which is the difference between MACD minus the MACD signal. Excellent. So now that we've finished studying MACD calculation and the visualization of this technical indicator within its corresponding chart, let's go back into the slides. And as mentioned previously, this tutorial has an educational and informational purpose and doesn't constitute any type of trading or investment advice. Please pause the video now so you can read the full tutorial disclaimer. Okay, so with this, we finished this tutorial. Thank you for watching.